You just can't beat the GameStop Stop. With the GameStop saga, we see a new development in the stock market, small Main Street traders taking on the big Wall Street hedge funds and winning, at least for a while. What is more, the action in this one stock seems to have spooked the entire stock market. Let's take a look at what occurred and what this may mean for investors. I'm Curtis Chambers with the Chambers Financial Group. The recent soaring price of GameStop has got everyone's attention, but the story really begins back in the 1920s with something called the old pump and dump scam. A group of traders seeking to manipulate a stock's price would choose a low-priced, thinly traded security and then generate rumors it was going to rise. Then the scammers would start buying the stock, driving the price up. When ordinary people saw the stock going up, they would believe the rumors and naively jump in, further pushing the price higher. When the retail investors had finished piling in at a high, the ringleaders would then dump or sell the stock at a profit. The stock would crash, and the latecomers were left holding the bag. We can think of this as a game of musical chairs, only the person playing the game is also controlling the record player. Let's break the GameStop phenomenon down into some steps. Number one, it all began with hedge funds. These are large, actively managed trading organizations that use non-traditional strategies. They employ sophisticated trading techniques and utilize debt, also known as leverage. Leverage amplifies gains and losses. If you remember the 1987 movie Wall Street, Michael Douglas's character is who we think of when we think of hedge funds.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good.
Number two, next comes selling short. Selling short is a trading method that speculates on a stock's price going down. When a stock is sold short, traders sell shares they do not yet own. They're borrowed and must be repurchased later. There is more risk because if the stock goes up, the short seller loses and the price can go up a theoretically unlimited amount. Selling short is a strategy often employed by hedge funds. They usually target weak companies they believe will continue to decline or to go out of business altogether. Number three, enter a target. GameStop is a brick and mortar retailer of new and used video games and equipment. The company has struggled as late as sales have moved online and COVID-19 has hastened the process. Some hedge funds had sold an enormous amount of GameStop short, with short interest as high as 138% at one point. That's more than all the shares outstanding. These hedge funds were a bit like vultures circling, betting GameStop was going to go under. The fourth factor is a new technology, online forums, where small traders share tips and ideas. These forums have become able to generate some real clout in terms of buying power. Some knowledgeable traders raise the idea of buying up GameStop shares to force the stock price up and create, number five, a short squeeze. As the price of GameStop rose due to the concerted buying from these online forums, at one point it was up 1,600%. The hedge funds lost an estimated $19 billion. It looked like some hedge funds were going to be bankrupted. And then number six, the empire struck back. The next day, some of the brokerages serving many of these traders, many of whom traded using apps on phones, suspended trading in GameStop and some related stocks. GameStop lost 44% of its value that day and began to slide as traders were unable to execute trades. These online brokerages offered free stock trading, but who was their real customer? I would never have imagined brokerage firms not allowing their customers to buy or sell publicly traded stocks on major exchanges. It felt to many like Wall Street had had the last laugh. GameStop came crashing back to earth, trading resumed but was limited, and GameStop's price fell, as you can see. What goes up for no reason must come down. I believe this event has shaken up Wall Street for several reasons. Small retail traders acting in concert to move prices on individual stocks is a new phenomenon. Markets don't like surprises. Manipulated trading is a problem, and it can have legal consequences. The door is open to additional regulation, and no one knows what that regulation may be. Most significantly, there is concern that this action reflects an unhealthy market. That is, one of excessive optimism. But is GameStop really a canary in the coal mine, warning us about an overheated market? I don't think so. Back in the 1990s, during the dot-com bubble, many stocks were trading at excessive valuations. But in this case, the action was limited to only several. I see this event more as a matter of a new technology. That new technology is online stock forums, giving retail traders the ability to influence markets using an old method, the famous pump and dump scam. None of this has to do with investing. It's all about trading. And that's a ball game I would avoid anyway. By the way, here's a look at GameStop today. If you have questions on the GameStop saga, please visit us online or at our office. We're not in it for the short term, not even until the GameStop music stops. We're in it for the long term.